Welcome to Module 6. We are ready for our last session of new material. We are going to be looking at unemployment taxes for this week. But before we do that, what I want you to do is go through and answer, not this one. Go through and answer this Module 6 12 review questions. We're going to check your answers here in just a bit. So go ahead and pause now. Okay, the answers for this review, mainly from, most of these will be from last week. Now I threw in like this first one here, it goes back a few weeks. Which form is filed quarterly for federal income taxes? You should have this one down by now. The Form 941. When are federal income taxes deposited? Well, they're deposited right along with the FICA taxes, and they are deposited based on your look back period. And remember, that's either monthly or bi-weekly. Take this out, not semi-monthly, but bi-weekly. So they're filed either monthly or every 2 weeks. When would box 1 differ from box 3 and 5 on your W-2? Okay, so the almost clear-cut answer you want to answer here is when you have a retirement withholdings going into some kind of retirement plan. Those are not deductible. Those are deductible from federal income tax. That's box 1. That's your federal income tax wages. They are not deductible for box 3 and 5, the FICA taxes. So boxes 3 and 5 will be higher. When would box 3 differ from box 5? Well, that's only going to happen when you've hit the Social Security cap. Box 3 will stop at the cap, and for our class, 137,700. And box 5 will just keep going, showing your total taxable wages. What is Indiana's state income tax rate? That is 3.23%. State taxes are based on where their state is based on where you work. If you work and earn money in a particular state, you're going to have to pay tax in that state, and you're going to file what's called a non-resident income tax return, assuming you don't live there. And you file a resident tax return where you do live, and also assuming that that state has income taxes. Remember, there are 9 states that don't. What is a reciprocal agreement between states concerning state income tax? Well, that's an agreement that you only pay the tax on where you live for those states in that reciprocal agreement. So we had the example of Indiana and Kentucky. You live in Jeffersonville, you work in Louisville. Kentucky's going to waive the requirement that you file and pay income tax there because of the reciprocal agreement. You only pay and file for Indiana, where you live. List 3 states that do not have an income tax. So this is just to make sure you know a few of them. Some of the main ones, we've got Alaska, we've got Texas, we've got Florida. Those are 3 that come to my mind right away. Let me see. I might have skipped one in my answers here. What is a list? Oh, I don't even ask that. Oh, I skipped one, yeah. List 3 states Indiana has a reciprocal agreement with. All right, so the 3 states, any state around us except Illinois, that's the easiest ones to remember, the 3 easiest ones. So Ohio, Michigan, and Kentucky have a reciprocal agreement with us. There's also Pennsylvania and Wisconsin, if you wanted a couple extras. Illinois does not. List 3 states that do not have income tax. Okay, that's the one I skipped. That's the 3 that I said, or the 3 that I put on here. Yep, so those definitely came to my mind back then, and they came to my mind now. Florida, Texas, and Alaska. Indiana county taxes are based on where you live. So it doesn't matter where you work for county taxes. They base on where you live. The fair tax, we talked about that towards the end. Remember the fair tax, which taxes would it eliminate? Well, pretty much all of them. You're not going to have any payroll tax. So your FICA taxes, Social Security and Medicare, federal income tax, it's going to get rid of the corporate tax, gift and estate, lots of them. The only ones it won't necessarily are the state taxes. But if we would ever go to a fair tax, which I probably unlikely, but if we ever did, I'm guessing the state taxes would follow suit and they wouldn't have you do income tax either, because that would be it'd be extra work just for that state. The fair tax would be similar to what type of tax we're already used to. It's going to be very similar to the state sales tax. You pay a percentage on when you buy something. All right, let's get into our new material, our FUTA and our SUTA taxes. So FUTA, Federal Unemployment Tax Act, was set up so there is money available for those that get unemployed through no fault of their own. The whole reason that FUTA was set up was simply to have a fund available that states can borrow from during some really hard times when they're having to pay out a lot of unemployment and they run out of money. They can borrow from this FUTA fund. And that's what it is. You're borrowing. You're not getting free money because you do have to pay it back. Indiana had to dip into the FUTA back in 2010, around the 2010, 2011 area around then. And then we had to begin to pay it back. And we finally got it paid back. We'll see a little bit more detail of this. Finally got it paid back either late 2015 or in 2016, I believe. Maybe it was 2016. The SUTA tax, this is where your actual unemployment money comes from. It comes from the individual state. The state collects money, and then they collect money from all the employers. And then they hold the responsibility then of paying out unemployment benefits based on how long you're off. If you're off through no fault of your own, they're going to check through all that. And then when you get a new job, of course, it's going to stop. Now, we're going to talk about paying the employers who have to pay into this. One of the key things to remember is with FUTA and SUTA for Indiana, these are only paid for by the employer. This is only one of those second journal entry items that go into the payroll tax expense. These don't come out of the employee paycheck, which is good. For FUTA, they never do. There are a few states that have SUTA taxes taken out of the employee as well, which is kind of rough. Let's keep going down here. An employer, notice here, an employer may have to pay into more than one state for different employees. So if you have 6 employees and 3 of them work in Florida and 3 work in Georgia, primarily, that's where their main clients are, then you're going to pay SUTA taxes into both states because it's, as we'll see here in a little bit, SUTA taxes are based on where you're primarily working in. So if we could pay into different SUTA states, but we'll only pay into one SUTA state per individual employee. So even if that employee jumps around to different states, there's a criteria system that says which state, we got to pick a state that they are the most, that they're in the most. And we'll see that in a little bit. Basically, you pay into the state, and that's wherever you pay into the state for that employee, that's where that employee will have to turn to get unemployment should they become eligible. Okay, so again, SUTA is primarily funded by the employers. There are a few states, and I believe Pennsylvania is one, that a small percentage does come out of the employee's check. Every state has their own set of SUTA laws. It's required that it was required back in federal law that every state have a SUTA fund for unemployment. Indiana has a very detailed list here. You can click here and get the whole scope of what you need to do to get unemployment. Lots of things going on there. I'm gonna try to hit some of the high points, but if you are in that situation, you'll definitely want to use this link, or if you know somebody that's in unemployment. All right, so common unemployment questions, and we're gonna try to answer some of these. How much can I receive in unemployment benefits? Well, it's gonna range between a low of $50, and this is weekly pay. You're paid per week, 50 up to 390. Now, even 390 is not that much. If we multiply 390 out per week times 52 weeks, if that's all you got was unemployment for an entire year, I mean, it's right at like the poverty line. I think the poverty line is around 18 to 20,000. So it's not terrible. You're going to still hopefully be able to make it. But if you had a high mortgage or a high rent, then you're going to be in trouble. All right, so how you determine where you're going to fall in this range between 50 and 390. What you first do is you look back over the past 52 weeks and you add it all up, and then you divide by those number of weeks to figure out what your average compensation is. Then you simply just multiply that by 47%. And that's how they determine where you fall within this range. If you're over 390, you have to stop at 390. So with this little example I had, a person made 30,000 over the last 52 weeks. They got laid off. So you divide 30,000 by 52. That's what it comes out to be on average. And then take 47% of that. So this person's eligible for $271 per week. Now with the COVID, and this is going back between about April to July-ish of 2020, federal tacked on and allowed you to take out quite a bit more for unemployment. You got up to like $600 extra bonus per check. I believe that's what it was. So for a little bit, they gave you quite a bit of extra money, definitely enough to live on. But that has since expired unless something more comes about. All right, how long can I remain on unemployment? The normal answer is 26 weeks. And you'll see that if you read through the unemployment for Indiana. But the CARES Act did allow an extension on that because they know it may be a little harder for you to find work. So they added basically another 3 months, another quarter, 13 weeks. So now this is a total of 3 quarters or 9 months that you can potentially draw unemployment from. Do I qualify for unemployment? Well, as long as you have met some of these criteria here, in the last 4 quarters, your wages had to total at least $4,200. So if you didn't make at least $4,200, you may be in some hurt. So wages totaling $4,200, and with 2,500 of those in the last 6 months. So over half within the last 6 months. You can't have it all a year ago. Okay, so hopefully that's not too hard. You know, within the last 4 quarters, you need to only earn $4,200. That's pretty low. Let's keep going here. Be unemployed through no fault of your own. So basically, if you're laid off, which a lot of people were for COVID, there wasn't reason to have the stores open when they could not open their doors to the public, so that people got laid off. There are a few instances to where you can quit and still get unemployment if you meet one of these criteria down here. But most of the time, if you just simply quit, you won't get unemployment unless you can prove one of these items here. And you better have some documentation through like the HR of your company if you had harassment at the job. All right, and then you also, to get unemployment, you will also have got to weekly fill out this form that shows places that you're looking for work, places that you have applied to, because they want to make sure you are searching. They don't want you on unemployment for very long. Suitable offers, you have to accept any suitable work. And suitable means it's near the same location as your previous job, same type of work, and same pay. Now, the term for suitable begins to expand the longer you're on unemployment. So more things become suitable at that point, and the amount of pay that you have to take begins to dwindle a little bit. And you'll see here during your weeks 5 through 8 of being unemployed, the pay then is suitable if it's 90% of what you normally had made. And then after the 8th week, if it's 80% of what you previously made, that is now considered suitable. And then note here, you can qualify even for partial benefits, even if you are still working, but your hours have been cut drastically down. So you think, well, I'm not technically unemployed. That's okay. You can still get some benefits. They will cut into the total that you normally would have received. So if you were normally going to get $270 a week and you got $100 already just working, then they're going to take $100 off of that $270. So you're going to get now only $170. You're still going to get your full $270, but you worked for some of it. Okay, employer responsibilities. Basically, if you have any employees, you're going to pay into FUTA. And these are the two criteria. You're going to pay into FUTA and SUTA. Taxable wages, if you have taxable wages to an employee or any employees for $1,500 or more in a quarter, so that's a pretty low amount. Or if you employ one or more people a day, a week for more than 20 weeks. It doesn't even have to be the same person. So one person once a week for at least 20 weeks, you are required then to fill out FUTA paperwork. All right, people who are not employers, these are people that, now, let me take a step back here. You are an employer if you're an independent contractor and you hire your own employees, then you automatically become an employer. And then you've got to, but if you're just an independent contractor with just you working for the business, then you're not your own employer. All right, so these people are not employees, independent contractors. They don't have to pay unemployment on themselves. So they don't have, but they would if they had employees that they hired off to the side or, within their business. Let's say you have your own painting business and then you have 3 other painters who work under you. Those are your employees and you would have to fill out FUTA taxes and SUTA forms. Partners of a partnership, these guys are not considered employees for FUTA purposes. They're kind of like an independent contractor. They have their own forms that they fill out. Like independent contractors do a Schedule C. These guys have their own form. Insurance agents, remember we talked a little bit about these. These guys are insurance agents who's paid solely on commission. And a lot of them are. These guys are independent contractors, basically. They are their own boss. They have to pay the company that they work for just to be part of the company. All right, let's keep going down, look a little bit more in depth at that. We went over this at the beginning, week 1, but it's good review here. FUTA tax. First big thing here is, I'm going to put this in bold, I think, as well. The employers, your tax, the cap is first $7,000 on your federal taxable wages. Okay, not your gross wages. So it uses the same thing as federal income tax. They're going to look at that amount to see if you've hit this cap. And then once you have, then you don't pay any FUTA tax for the rest of the year for that employee. Each employee has to hit a $7,000 before you stop paying for that employee. And then the percentage is very, very low, 0.6%. As you can see as a decimal, 0.006. All right, big thing to take away here, the cap, everything's based on your federal taxable wages. Same with SUTA. And this is just for Indiana now. Indiana has a rate of $9,500, meaning the employer will still have to pay taxes up to the first $9,500 in taxable wages, federal taxable wages. So you'll stop at FUTA at 7, but still pay a little bit longer into the SUTA rate. Now the SUTA rate all is dependent. I'm going to have to give that to you. This is always set. This number is set. Every company has to pay that. The SUTA rate, well, that depends on how often you let people go and how often people then have to dip into the to the unemployment benefits and start taking money out. So if your employees are the ones taking most of the money out, then your type of company should be the ones having to put the most in. And that seems like the fair way. And that's how Indiana does it. Now, until the state knows where you're going to fall at with laying people off or not, there's an introductory rate that every new employer starts out with, 2.5%. And then I took the liberty of saying, okay, 2.5% times the first $9,500 in wages for an employee. So that means when you hire somebody, you're going to be paying $237 into SUTA for that employee, assuming they make at least $9,500 for you. Once you're established, then the rate can vary quite a bit. You can be a really, really trusting company that almost never lays anybody off, and you get a very, very low rate. It's kind of like, think of it just as like your insurance premiums. If you get in a couple car wrecks, your insurance premiums go way up because you're the one that's taking money back out of that company. Same thing here. If you start laying a lot of people off, you're going to be on the high end. There's a big difference between 2.5% and up to 9.4%. That's a lot more money coming out of the employer's pocket. Okay, so what I want us to do here is that in this first example, I want us to practice figuring out what's our FUTA and SUTA taxes. So let's read through here. Our federal and FICA taxable wages per pay are listed and have not changed since the beginning. This is the fourth pay of the year. So all we're doing here is we don't have any, this is their federal and FICA taxable wages. So I've already taken out if they had any medical premiums or anything like that that would not be taxable. That's already being factored in here. You're going to look at this to determine how close they are to the cap. And then just like with Social Security, you're going to do step 1 and step 2. Step 1, did they go over the cap this pay period? If not, you're going to use just the current pay. If they did, then you got to go to step 2. If they're already over the cap, then it's just 0. So what I want you to do is total up for the 3 employees what their total FUTA tax and total SUTA tax is, and then prepare only the second journal entry. You don't need to do the first one with the wage expense and all that, because I don't give you all that information. You don't know their federal income taxes or how to even figure it up, because I don't give you enough information, like if they're married. So go ahead and let's fill in this, put in your amounts, journal entry, and then we'll check our answers. So go ahead and pause now. Okay, with example 1, let's first look at Joe. Joe, year to date, 4,500. If we add in an extra 1,500, he's only at 6,000. He's not over any cap. So Joe is going to have the full amount taxable. So taxable for FUTA, full 1,500. And then of course for SUTA, if you don't hit it for FUTA, you're definitely not going to hit it for SUTA. So all I ask for here is just to determine the amount that's taxable. And then we'll, at the bottom, when we total it all up, that's when we'll figure up the total tax. For Carrie, the 6,000, if we take step 1, 6 plus 2, that's 8,000. We're over the cap for FUTA purposes. So then all we need to do is go to step 2, take the cap, 7,000, minus where she's at right now, 6,000. So 7 minus 6 says 1,000 is taxable for FUTA. So we're going to put 1,000 here. Now, for SUTA purposes, if we take 6 plus the 2, that was 8. That is not over the SUTA limit. So she'll have 1,000 for FUTA, 2,000 for SUTA. I'll show you the calculation in just a minute with this little star. And then Leah, already over the cap for FUTA, so her amount here will be 0. And then for SUTA taxes, if you take 87 plus the 29, that's over the cap of 9,500. So step 2 says take 9,500, the cap, less where she's at now, 8,700. So that leaves $800 taxable for FUTA. And then here are those two amounts. If you didn't get them, you'll want to pause at this point and see what I did. All right, now getting the FUTA and the SUTA is actually very easy at this point. All we got to do is take 2,500 times 0.006, and that would be my total FUTA tax. Just simply $15, so not a lot. The SUTA rate, or the SUTA tax, times the SUTA rate is 1.9 for this company. I have to give that to you. So 4,300 times 0.019 or 1.9%. Now we're ready for the payroll second journal entry only. I now have the SUTA and the FUTA taxes payable. Those are going to be part of the journal entry. The only thing left that I need to figure up is their Social Security and Medicare. So they're nowhere near the Social Security cap of 137,000 yet this early in the year. So all I'm going to do is take the current pays, add them up to get my taxable wages. Remember, these are the taxable wages. 6,400 was the total Social Security taxable wages. Just simply multiply that by the 0.062. So 396.80 would be my Social Security payable. And then take the total wages again, which was 6,400. When you add all those up, 0.0145, 92.80 for Medicare. And then these guys come last, FUTA payable and SUTA payable. The payroll tax expense is simply all of our credits added up. What do we owe? And that is our payroll tax expense. Okay, if you need a little extra time to get that, go ahead and pause. And I'm going to keep moving on. All right, for a lecture example number 2, we're still going to do the same thing. We're still going to calculate the FUTA tax and the SUTA tax, but we're going to take one more step backwards. And instead of me giving you the federal income taxable wages, I now give you the gross amount. And I want you to determine how much is taxable. So out here to the side, this may be where you want to put the actual taxable amount, and then calculate it out to what their current year-to-date earnings would be, noting that this is the third pay of the year. So that means they've only worked 2 other pay periods. And then how much of whatever you have out here is actually going to be taxable for FUTA and SUTA based on the caps. So you're going to put like FUTA over here and maybe SUTA over here, assuming if there's 2 different amounts. All right, so go ahead and try this one and pause now. All right, so let's look at our Looney Tune characters here, Tom and Jerry, and then we got the Roadrunner and our Wile E. guy. All right, let's go through. I'll put some of the answers out here to the side. Let's pull up our calculator. We've got Tom starts out with 4,000. Yep, we can subtract the medical premiums and the flexible spending, but we do not mess with the 401k. We do not deduct that. Or excuse me, we do deduct it. I don't know what I'm thinking there. We do deduct 401k. Take that back. Let's start over again. Take the 4,000 minus the medical premium, minus the flexible spending, and we do get to deduct the 401k. We do get to take that out for our federal purposes. So out to the side somewhere, it would have said, let's put a new category here, federal income tax wages. So this is a new item. this would be 3530. Jerry, we can deduct everything. We can deduct everything for all of them. 3470. I'm hoping I put in these amounts right since I'm doing them on the fly. Roadie, yep, we can deduct all of our normal federal tax items. 3,100. And finally, Wiley, 80, 80, 80 is 240, 1760. Okay. Now, we're ready for our year-to-date. So all I did, take the 3530, times it by 2, $7,060. That was our year-to-date earnings. Now, that's over the FUTA rate already. So nothing goes here. If I take 7,060, and if I add in the 3530, yep, that takes us over the SUTA rate. So we're going to have to go step 2. Step 2, take the 9,500 SUTA rate, subtract out where we're at already, 7,060. So there's the amount that Tom is going to have to pay in, or the, not the amount, but how much is going to be taxable on top. And then after this pay, he's going to hit the cap for both of them. Okay, so I'm going to keep a running total out down here to the side. So then it's easy to calculate my taxes. All right, for Jerry. Jerry was at 3,470 times 2. So $6,940 is our year-to-date. So close to the FUTA. FUTA, he definitely goes over. You can just do that in your head probably to see what's left. 60 bucks left to be taxed on FUTA. Then if I take the 6940, add in the current wages, 3,470, we're over the cap. So we're not going to use this full amount. We're going to take the cap, 9,500, subtract where we're at, 6,940, and that's where I got the 2,560. And then all I did is took the $60, and you didn't even have to do this over here. I didn't even, this part here and this part here wasn't even on your sheet. This is just my calculations. You could have just added these all up, the FUTA side, 0 plus the 60 plus the other 2, and then multiplied that by the rate, and that would be perfectly acceptable. So let's get the last 2 here to show, now that you kind of have an idea of how to do this. Roadie, we had $800 left for FUTA, and then the full 1,760 for Wiley, and then the full 3,100 for Roadie for SUTA. If you add up your FUTA wages and then multiply it by 0.006, you're going to get $15.72. Then you add up all your SUTA wages and you multiply that by, well, I didn't even give us a SUTA rate. I got to put that in. What did I use? I don't know. Let's, I guess I'll have to do the division and see. 61 divided by 2,440. I did 2.5%. Oh, new company. I missed that. So I'm guessing several of you were. Assume this is a new company. So I better bold that and underline it. So remember the new company rate, 2.5%. Okay, now that we know how to calculate it, let's go back to a few of the rules and regulations on, especially if you work in more than one state. The employer doesn't want to have to pay SUTA, and they won't have to pay SUTA taxes in more than one state for you. So the key things are for only one employee, you're only going to pay into one state. But if you have multiple employees, you could definitely have to pay into multiple states, depending on where that individual employee works the most. So here is the criteria, and these are based in order of importance. So if you meet number one, then you stop for that employee, and that's where the SUTA taxes are paid. The state where the work is localized. So where is that employee doing most of their work? That's where they're going to pay. That's where the company is going to pay the SUTA tax into. So even though you may go to other states and perform work, most of your work is done in this one primary state. That's where the SUTA is. So I got my sales rep here, primarily works in Indiana, but does travel across the border to Ohio on occasion, maybe a couple times a month. No big deal. You're still going to be paying into SUTA though, because you're primarily located in Indiana. Now, what about this guy here? This guy who lives in Gary, Indiana, but travels across the border to work in Chicago. The employer actually is going to withhold for that employee for Illinois. They're going to pay into Illinois SUTA tax. And if that employee would ever get laid off, they're going to have to go through Illinois to get unemployment, because that's where their primary work was localized. Now, if you don't really have one area that you're in most of the time, then you got to come down here to step 2. So this one is especially the case if you're not in any one area or you have equal time in different states. Then you're going to come down here, place of the employee's permanent nature. Where do they come back to at the end of the day and start their day? That's where you're going to have their unemployment go to. Then there's a couple other criteria here that you can look towards to see, and if as long as you, wherever these fall, that's going to be the state you use. If for whatever reason still number 2 fails, then where are your instructions coming from? Where is the company? Where are your supervisors located? That's going to be the state. And if all else fails, because everybody's moving around, there is no set one state, it's where is your residence? That's going to be the last thing they're going to look for. Now, there's a chance, I mean, almost everybody has a permanent residence that is working. There's a few I could maybe think of. If you're a long haul trucker, maybe you don't. There may be some situations where you wouldn't have one necessarily because you're gone all the time. But most people, even long haul truckers, usually have someplace, even if they're not there that much. I thought this was pretty interesting to look at the unemployment stats, especially as we went through the COVID era and still are, but has gone, the curve has definitely gone back down. Just before the COVID pandemic hit, we were at a very, very low rate. The normal rate is around 5% is where the US unemployment, and that's considered a pretty healthy. 3.5 is very healthy. You don't want to get too low, because too low means there's positions out there and there's nobody to fill them, or no competent individuals to fill them. So 3.5% is considered very, very healthy. That was right before the pandemic. You can see what happened just 2 months later. Jumped almost to 15% of the workforce was unemployed. That was really high, especially when you compare it back to when a lot of people were laid off during the recession. That never got much above 10%. So even though this one was a spiked and it didn't stay up there, thankfully, it was higher for a bit than the recession. Now the recession lasted quite a bit longer. It was up in that 8, 9, 10 for several months. Whereas in September, and I would say even in October, it's probably going back down even a little bit more. So we're back down below where the recession was. Indiana, we followed the same spikes as the US. Very low before. We actually went above the federal in April. And right now we're, the Indiana rate here, it's actually probably going to be a little lower, because notice the September and July amount. I didn't get that one updated. Either Indiana didn't update yet, or when I had last looked at it. Recession, you can see how we were a little higher. We had more factory type jobs. Therefore, it was a little bit higher than the Fed. Okay, we have one more new form that we're going to look at. Our new form is the form 940. Just some quick little things about it, and then we're going to go through the form like we did with 941. So this annual form 940, note it's the typical, the normal deadline is January 31. You got to fill it out only once a year. It's an annual form, unlike the 941, we have to do that one quarterly. Now, if you have all of your payments on time, when you were making your FUTA payments, then you have an extra 10 days till the February 10th. You're going to pay these electronically, most likely, and that may be usually the easiest. Notice here, when you have to pay your FUTA taxes, there's a little caveat here. Typically, they're due by the end of the quarter. But since a lot of times these are small amounts, especially if you don't have very many employees, they say you don't have to pay by the end of the next month if you're below 500. If you're below 500, you can just carry that amount over into the next quarter. And so as long as you don't exceed 500, you don't have to make that quarterly payment. You can, you just don't have to. So no deposit if you're less than 500. So I give this little example here. At the end of the first quarter, we had collected 300 in our FUTA tax payable account. I don't need to pay that then by the end of the next quarter, by the end of the next month for that first quarter. Then let's say we kept tacking on, we had new employees, some of our other employees hadn't quite reached the cap yet. We added another 300. Now we're at 600 in our FUTA payable. Now at this point, we would have to make payment of $600 on or before July 31 because the quarter ended June 30th and we have until the end of the next month. If you still haven't even hit 500 or you made a payment up here sometime during the year and you're still below 500 now for the end of the year, you do go ahead and send in whatever you still owe at the end of the year when you send in that 940. All right, let's go through the Form 90 as the Form 940 as we, I'll kind of keep this up as well because there's some things that this may help. So if you haven't, you may want to pull this up or you can just follow along here with me either way. All right, again, we have our EIN number, just like Social Security, where we will almost never fill in anything over here. For the 941, this is where we put what quarter we were in. But for 940, it's only an annual form. So these are just some weird things that happen. Here, we're simply going to put what state we're doing this for. And then if we had, of course, lots of people in lots of different states, we'll have to click here and then do some other stuff, other forms. The credit reduction, that would be if we have to pay back some of the FUTA, we would check there and come down to box 11. All right, so let's go in. This is the main part of the 940 that we're going to fill in all of it always. Line 3, this is different than 941. 941, it asks you for the federal taxable wages. This one is actually your gross wages. They have you do the gross wages just because they're going to have you take out the other stuff here and here, or basically mainly here. They want to know which items are you taking out of your paycheck. So these are the items that you can take out. Basically, this gets you down to your federal income taxes payable or your federal income tax wages. But just note the box 3 is your gross wage. And that's what I put here in the instructions. And then you add up all of those non-taxable fringe benefits that each employee had taken out of their check for the entire year. And then you come down here and then whatever, let's say the employee had federal income taxes, all of them. Let's say we had 3 employees. Just to make it real easy. All 3 employees had federal income taxes wages of $10,000. So that means they all were over the cap by $3,000. So we would put in the 3,000 times for the 3 employees, we would put in 9,000 here because I want to put in total payments in excess of the 7,000. So if each employee was 3,000, we did 3, 3, and 3 would be 9,000 that would go here. Then it says, okay, add up line 4 and 5. These are basically going to be not taxable. And then we're going to subtract. We're going to take line 3 minus line 6. Tells us how much few to taxable wages we had, and then times it by the rate. Now, what I find is easiest, and I put that here, a lot of times it's easier for you to do it off to the side, like what we were doing to figure out what's your total few to wages. Start here, put this amount in first, then come up here and then answer, and then you can start working backwards. And on one of our problems, we'll do that. I think you'll see that it may be a little easier. It's a little easier to work backwards a lot of times. We can start filling in different boxes, maybe out of order, which in some cases could help. Okay, box 9, 10, and 11 we're not going to do. We're not going to do box 11 because we've paid off our debt. If you were in the years, if you were taking this class between 2011 and 2016, we would have had box 11, and we did. But now we're going to do it just like how we would now. We're not going to have box 11. So box 12 is going to simply equal box 8. And then the box 13, basically I want this box to equal what your box 17 is. So this form, just like 941, has how much did you owe each quarter? And then we're going to need to just figure that up. What was our liability at the end of quarter 1? And then add them all up, and hopefully box 17, it'll come up here and be in box 13, and that better 12 and 13 should match. Okay, just one little item here on line 11 before we look at an example. So this line 11, what would have had to have happened here, whenever you do borrow money and you have to start paying it back, what FUTA says you need to do is for every year, you're going to tack on an additional 3 percentage points or whatever, or not 3, but 0.3 to your normal 0.6. Remember, you normally pay 0.6%, which is very low, but then every year until you pay it back, you're going to add on an additional 0.3. So when Indiana did this, so this is back to 2014 now, and this was the 4th year that we'd been paying it back. So we've been paying it back in 2011. We borrowed in 2010 or 2011, and we start paying it back right away. 2011, 2012, 13, 14, that was our 4th year. So we take the 0.6, our normal, what everybody pays, and then we had to tack on, the employers did, an extra 1.2%. And that was that 0.3 for the 4 years. So total FUTA rate, instead of being 0.6, was 1.8. And that's the extra amount would have gone here in line 11. 2015, it went up another 0.3. And then finally, everything was paid off. 2016 was back to the normal 0.6. All right, so on this example here, I want us to fill out our 940. So we're going to take, and this may be easiest if you were doing it in Excel. I don't know if that's going to be easier for you or if you want to print this off, because a lot of times it's going to be easiest if you start marking things out. So Jack, the first thing we'd want to do, and I'll pull up my answers to show you kind of what I mean. I think it's easier to do it in Excel. Lecture number 3. Okay, so the first thing I did, and you can do this. All I did is just copy this chart and put it into Excel. Nothing going on here. This is just total gross wages. Then what I did As I said, all employees had 200 taken out per quarter for 401k, and that is a legitimate deduction that you can take off of your wages, and medical premiums. So what I did is I came down here and made a new chart. And I said, okay, this is how much, this is going to help me figure up line 4, because remember line 4 asked how much in total payments were exempt. So all I did, every employee was the same. So 200 and 300. So $500 for every quarter that they worked. And that's how I'm going to end up getting my line 4. Then come down here and figure out what's actually taxable for FUTA. So this is where you would want to, I'm going to hold off and have you calculate. And I'll show you what I did for maybe Jack. Well, let's just do Jack first. So Jack, I said, okay, they made 5,000 first quarter, but this isn't taxable. So really taxable is 4,500 for Jack in quarter 1. And then come to quarter 2, it's 4,500 again. But if I put in 4,500, that's going to put me over the cap. So I've got to stop it. I got to take the cap minus where I'm currently at. That's how much is left to be taxed in quarter 2. So what I want you to do is fill out a similar type looking item, and I think this will help you fill out the Form 940. And we're going to see how you do. So I want you to try to fill in as much of the 940 as you can, and we'll go through the answers. Okay, so let's see if you set it up like how I did. This is what I had for the payments exempt. Jack, he worked every quarter, so he had 500 every quarter. Same with Jill. Kramer and Zena, well, they had 500 for when they worked. Now we come down and I took their gross wage minus how much was taken out of their check. So I did the same for Jill. Made 6,000 minus the 500. So quarter 1, she's not over the cap, but quarter 2, she hits the FUTA cap. So only 1,500 left. I want this number to not be over 7,000. For Kramer, similar to Jack, and the same for Zena. They just started a little bit later. So we actually have some FUTA tax that's being paid per quarter. Or not necessarily paid, but at least being accumulated. So these are the total amounts that you should have. And this would be our box 7. When you add up the 7,000, and this is how you can begin to work backwards. This is kind of how I would do it. You have box 7 right here of the 28,000. You could go ahead and fill in box 8 at this point. You're just simply taking that 28,000 times by 0.006, so 168. Now, I know what the gross wages were. This is where I can, it helps when you have a start work backward, and then you can start filling in different amounts. The gross wages, I come all the way up here, and I had that calculated. That was 69,000. Now I know what box 6 has to be just by the math, because A minus B has to equal C, because line 3 minus line 6 has to equal this. So I can just do the math. 69,000 minus 28,000 at my ending point says this number has to be 41,000. Now line 4, I got that by my chart, my second chart. And that was 6,500. Now I'm going to do the math again. Line 4 plus line 5, as it says here, has to equal line 6. So I can do the math to figure out what line 5 has to be. How much were we over the cap after these items that aren't taxable? So simply just take the 41,000, subtract out the first 6,500, and then this guy had to be 34,500. And that would be our answers. We could compare to what I had. That's how I would easily fill out the Form 940 for the top part. Line 11 would be 0. Line 12 would be 168. Now for the bottom part, before we get, I want line 13 to be whatever this is. For the first quarter, all I want to do is find out what my total taxable wages were in quarter 1, 10,000. So take 10,000 times 0.006, 60 bucks. And we're going to do the same thing using, this is our third chart that I made to figure up how much this line 7 was, using the same chart, just going per quarter now. 8,500 was how much was taxable in quarter 2 for my employees. $51. 7,000 times 0.006, 42. And 2,500 times 0.006, 15. Now, when I add all these three up, it better be the 168 that was here in box 12. So we'll check it, the 15 plus the 42, 51 and 60. Yep, 168. So 168 is my total, and that will come up here to say that's what I have deposited. Okay. Just a couple more items to look at before we finish up, and we're going to take just a few minutes and look at one other aspect here that that is part of payroll, but doesn't really necessarily go with this section, but this is the only place that really will fit. We're going to talk about garnishments. The suitor for Indiana, just for your knowledge, we're not going to do anything with these. But so with the federal, you file the Form 940, and then you submit your payments on these, usually electronically. For Indiana, what they have you do is they do quarterly reports. So it's called a UC1, this quarterly report here, contribution, how much that you have paid in. And then the UC5 is how much the wages. So Indiana has these two forms, just so you have in the back of your head. If an employer ever says something about a UC1 or UC5, at least you'd be like, okay, that was the unemployment. Think of the U for unemployment. Indiana employers are required to file quarterly, even if they have no payroll. They'll just simply put on there nothing to report. So they do require quarterly because it's a quarterly form. All right, our last little, and this is just miscellaneous items, the garnishment of wages, that comes out of your payroll. That's basically you're not paying your bills. You're not paying what you owe on time through your own will. So people are going to step in and take it out of your paycheck before you even get it. Hopefully that doesn't happen to most of you. But it is a way. It is a way of life. It happens. Sometimes you owe it out of your control and you just didn't have the money. And that's just, they're going to take it out anyway. All right, so legally, employers have to withhold when there's an order by the courts. However, there are some debts that do not require a court order. If there's child support, there can be a simple, just little the person doesn't have to go to court and get in a court order to get garnishments. They basically go to court and say, hey, this person hasn't paid me. The court looks at it and says, yep, they didn't pay you. And boom, they send it to the employer. You don't have to go through a judgment. And they will have child taxes taken out, child support. Back taxes, if you haven't paid your taxes, the government's going to get it one way or the other. So they're going to take it right out of your paycheck. And then student loans can come in and garnish your wages without even having a court order. Now, a lot of the garnishments are all dependent on your disposable earnings. Okay, so they can't come and just take everything. Your disposable earnings are basically your net pay or your gross pay. I'm going to put here not net pay. Let's put in gross pay. I think that'll be a little bit, because you can't take out things like health insurance premiums. That's part of your net pay. Can't take out charity or 401k. So it's basically your gross pay and any taxes that are required by law. So they're not going to count that against you. So that's why I put net pay. I don't know. So they are going to, whoops. I guess since I put the qualifier in here, it's kind of a hard one to put. So net pay in that they're not going to make you spend money that you don't have because you're already having money withheld for state, for like pay Indiana and the county taxes and the federal and Social Security. So in that part, it is net pay, but they're not counting these optional items as part of your net pay. They're going to add those back in basically to your net pay as your disposable earnings. That's your choice to have health insurance or your choice to put away for a 401k. Basically, they don't want you to have the absolute best health premium just because you don't want to give it to your spouse for child support. You're just going to give it all to the health insurance and put it all away into a 401k, leaving nothing for the child support. That's what they're trying to get away from. The employer cannot fire somebody if they are subject to one garnishment. The key there is one. If you have more than one, then you all bets are off. The employer can begin to fire you, and that be the qualifying reason. Employers do not have to do this for free. They get a court order. That's going to take some extra work, some extra checks to be cut, some extra deductions to be factored in. They can charge a fee for every time that payroll is due, and they have to do a garnishment. So you can see how much they can take out of your check, $2 per check addition for any child support they take out as a maintenance type fee, and then up to $12 or 3%, whatever is greater. So that could be quite a big amount. Half paid by you, half paid by the creditor, that fee. This Consumer Credit Protection Act basically says, okay, we're not going to allow you to take everything out of the worker's check. It is going to be limited, but for child support, we have a pretty high limit. So if you owe back child support, up to 50% of your disposable earnings can be taken out of your check. If you if the employee, you can have 50% even if you have another spouse or another child that's not part of the child support agreement. Even if you support another kid, they can still take 50%. They can take up 60% if you have no other child or no other dependent, no other spouse or dependent child that you take care of. So 60%, that's big. It's a lot of money. These amounts can even go up further from 50 to 55 or 60 to 65 if you're over 12 weeks back in back pay. The amounts are quite a bit less for student loans to come in and take money out of your check. 15% still a lot. Other creditors can take up to 25%. Notice here, if you have more than one creditor, there is a limit. They all can't come in and take 25% because then you're going to be down to nothing. So what they can do here, if there's more than one garnishment, child support's done first. So if you reach the limit, then the other guys just don't get any. They're going to have to wait till you've paid off your child support. Then you take the lower of one of these two, the lower of, and that's how much is left that they can take out of your pay. The lower of 25% of your weekly disposable income before child support deductions. So they can take out child support and then up to 25% for other disposable income. And then the, remember that's the lower of, or the difference between the weekly disposable income less 30 times the minimum wage. So minimum wage for Indiana, $7.25. So, or the difference between the weekly disposable income and 30 times 7.65. So if you only made in disposable income $300, they could take 300 minus that 229 that we just figured. They would have 70 bucks to take up. But remember, it's the lower of. And then 25% of your weekly disposable earnings. Let's see what that was. 300 times 25%, 75. So it happened. I picked one that came out to be almost exactly the same. Here's a little example just to kind of help show this. All right, we have child support due 75 bucks, 500 bucks a week that we earn. Weekly taxes, so that's part of the net pay that they count as they take off for your disposable earnings. So we're down to 400. 50 bucks a week taken out for medical premium, that's your choice. 3,000 debt to a credit card company that has a notice to collect garnishment. How much is taken out of his pay for child support and credit card garnishment? All right, so we have 100 bucks taken out for taxes. It says here, they already calculated the 75 for child support. I didn't even have you calculate that. Child support taken out 75 bucks. And then what I wanted you to figure up is how much can the credit card company garnish him until the 3,000 is paid off. Remember, we take the lower of 25% of his disposable earnings, 25% of your weekly disposable earnings. So 100 bucks, or the lower of your weekly wages minus 30 times the minimum wage, 182. So the credit card company can take out an extra 100 bucks out of your pay. So his total pay after he made 100 bucks, well, really, he has to take out 100. So that's for everybody. So you'd be at 400. So instead of getting 400, he's minus the 75, minus the 100. He's down to only $175 coming to him after the garnishments and all the other withholdings. All right, that ends our module 6. So we're going to have I'm going to have a short little video. Some of you maybe have already actually seen it if you started the payroll project early, but I will put in a little video for getting started on the payroll project, kind of give a good overview. And this will be one of our last videos, especially of new material for this semester. I hope you've enjoyed it. Hope you learned a little bit about payroll and enjoyed the class setup. I know it was a struggle at first, probably, to not have a book, but I hope you enjoyed saving the $200 plus of the text and just using my notes and or some Google searches. All right, I'll see you guys later.